Okay, let's unpack this. You've shared materials about the market reaction.
Yeah.
Well, the reaction to that direct military conflict between Israel and Iran, that was Friday, June 13th, 2025.
Right. A major event.
And, your gut feeling might be, okay, conflict in a critical region like that, markets should tank.
Absolutely. And stay down.
But the sources you've got reveal something, well, pretty counterintuitive. After that initial shock, U.S. stock futures actually bounced back.
Yeah, into positive territory by the Monday.
So what's going on there? That's our mission in this deep dive, right? Use your material to figure out why the market did that. It wasn't just irrational.
Exactly. It seems like there were three pretty powerful forces intersecting that explain this rebound. It wasn't illogical when you break it down.
Okay, so let's start at the beginning. The initial reaction, that was predictable.
Oh, yeah, completely. A classic risk-off moment. Friday the 13th saw, a sharp global sell-off. The Dow dropped, what was it, over 770 points?
Big number. And Europe, Asia. Same story overnight.
Same story. Declines across the board. Yeah.
And the VIX. The fear gauge.
Spiked. Jumped 16%, hit 19. So it climbed over that 20-point level that usually signals, rising anxiety. People are buying protection.
Okay, so initial global panic, money looking for safety, fast.
Right. And this is where it gets interesting. The dominant force that kind of took over next was this powerful flight to quality. And specifically, money poured into the U.S.
The dollar strengthened.
Sharply. The U.S. dollar index rose, confirming it as the go-to safe haven asset.
And treasuries.
Yeah.
Usually money flows into bonds for safety too, pushing yields down.
It did initially. Yields fell, like the 10-year dropped to about 4.31%, a one-month low. Safe haven buying, just like you'd expect.
You said it gets interesting.
Because that reversed pretty quickly, actually.
Why?
Well, the market was already looking past the immediate shock. It started rapidly assessing the main economic risk, inflation. Specifically, inflation driven by higher oil prices.
Okay. So the fear of future inflation pushed yields back up.
Exactly. It actually overpowered that short-term demand for safe bonds. The 10-year yield went back up to around 4.41, maybe 4.4% by Monday. It shows the market was already thinking about ripple effects.
Did the sources mention anything already happening in the U.S. market that made it sort of ready for this inflow?
They did, yeah. There was apparently a pre-existing trend. Treasury data showed huge capital inflows already happening for months before this, hundreds of billions.
So the pipes were already open, so to speak.
Kind of, yeah. That channel for safety-seeking capital was wide open.
Okay, so force one, flight to quality, primarily into the U.S. What else was going on inside the market?
That's the second force, this really aggressive sectoral rotation. If you just looked at the main index numbers, you'd miss the drama underneath.
Meaning
capital fled vulnerable sectors. Airlines, travel, financials, they saw sharp declines. United fell over 4%. Visa, MasterCard, similar drops.
Makes sense. But that money had to go somewhere, right?
Precisely. It poured into sectors that look like they might benefit. Energy stocks soared. Oil prices initially jumped, 7%? Brent crude went above $74.
So stocks like Halliburton, APA Corp.
surged over 5% gains. And defense and aerospace too, Lockheed Martin, RTX Corp up over 3%. The market was pricing in higher spending.
And I remember seeing notes about cybersecurity too, given the context.
Absolutely. Companies like Palo Alto Networks were seen as, essential. So these strong rallies in energy, defense, cyber, they were big enough to offset the losses elsewhere.
And that lifted the major indices, like the S&P 500.
Right, because those indices are weighted towards these larger companies. So by Monday, the overall index was actually up.
Okay, flight to quality, sectoral rotation. What was the third piece driving this rebound?
The third force was the market's pretty sophisticated and, frankly, very rapid risk assessment. That initial panic on Friday, it priced in a potential worst-case scenario.
Like closing the Strait of Hormuz, that kind of thing.
Exactly. Analysts had warned that we could send oil towards $100, even $120 a barrel. Huge shock.
But the market quickly decided that wasn't the most likely outcome.
It seems so. It rapidly shifted to pricing in a contained conflict. Still tragic, obviously, but contained economically. The sources point to a few things here. Iran's actual share of global oil production isn't as massive as some others. Existing inventory levels helped, and crucially,
Spare capacity.
yes, OPEC Plus had an estimated 5 million barrels a day of spare capacity. That acts as a buffer, a fundamental counterweight to fears of a total supply collapse.
And maybe even the specifics of the initial strikes matter.
Yeah.
Reports suggested key oil infrastructure wasn't the primary target initially.
That could absolutely have factored in. It might have signaled the immediate goal wasn't, total economic warfare. That allowed the market to differentiate severe regional conflict, yes, but maybe not immediate global economic catastrophe.
So pulling it together, the market wasn't blind to the war. It was just quickly analyzing the likely economic impact based on the facts on the ground.
And routing capital accordingly. Finding safety in the U.S., hedging inflation with oil and gold, betting on sectors like energy and defense.
Given all that, what should you be watching now, according to these sources?
They flag key indicators. Keep an eye on oil if it breaks sustainably above $90 a barrel. That signals a potentially deeper economic hit. Watch the VIX if it stays consistently above 30. That means renewed, widespread panic.
And the dollar index, credit spreads too.
Monitor those as well, yeah. They give clues about which scenario might be unfolding.
What's really fascinating here is just how fast the market assessed all this nuance. Even with crisis headlines everywhere, it was simultaneously seeking safety and opportunity.
It really was. And it leaves us with an interesting question, something your sources raised for you to think about. Historically, the market impact of geopolitical shocks, no matter how awful they are in human terms, often turns out to be shorter lived than the impact of underlying economic fundamentals.
Right. So as look ahead, the question is, how much weight will you give to these geopolitical events versus those fundamental economic drivers shaping the longer-term picture? Something to consider.